All right. Well, let's go ahead and kick things off here. Thank you everyone for joining and welcome to this session where we'll go ahead and do a deep dive on navigating carrybacks and carryforwards in clean energy tax credit transactions. Next slide, please. A couple of housekeeping rules to kick us off here. We are recording the webinar, and we'll be sure to publish a video and transcript within about a week. We've also disabled participant chat and video. However, to the extent that you have any questions, please feel free to submit those questions anonymously using the Q&A box at the bottom of your Zoom screen. And finally, if you're having any connectivity issues, please email our colleague Sam, where she can be reached at sam@reunioninfra.com. A quick overview of the agenda here. We'll start off with welcome and introductions. We'll then give a high-level overview of carrybacks and carryforwards and how those look mechanically and operationally. We'll then dive into documentation, timing, and compliance considerations. We'll follow that with some practical insights from our panel. Time prevailing, we'll do a quick market update, and we will finish off with audience Q&A. Wanted to quickly give our panelists an opportunity to introduce themselves. My name is Alessio DeFalsis. I'm the head of commercial strategy at Reunion, and I'll be moderating this panel. I'm joined by a wonderful panel of tax and legal experts who we've been fortunate enough to have worked with very closely, and I'll pass it off to Brandon to do his introduction.
Awesome. Thanks, Alessio, and very happy to be with everyone today. My name is Brandon Hill. I'm a tax principal at CLA. I actually sit in our Kansas City office, but I lead CLA's Energy Tax Services team. So we do a variety of tax consulting services for both developers and tax credit purchasers alike, and excited to talk about some of the tax strategies around tax credit carrybacks today. Maybe with that, I'll kick it over to Debbie for an intro.
Yeah, hi, and thanks to Reunion for putting this together and for having us. I'm Debbie Harrison. I'm in the DC office of McDermott, Will, and Schulte. My renewable energy practice focuses primarily on the transactional side of things. So I do M&A, BTAs, tax equity, and for the last couple of years, a large number of tax credit transfer transactions. The firm, we have a group of about 60 or more attorneys who actually are focused on the renewable energy. So we are able to do everything from soup to nuts with finance and the supply agreements and everything like that. So glad to be here today. Thank you.
Yeah, hi everyone. My name is Mark Christie. I'm a tax partner at Orrick, based out of our Chicago office, and I specialize in really anything related to renewable energy tax credits, including tax equity transactions and what we'll talk about today, tax issues related to tax credit transfer deals. So good to be here.
Thanks, everyone. And perhaps just a quick overview on Reunion. Reunion supports corporate taxpayers throughout the tax credit acquisition lifecycle. What that really means is that we work closely with tax credit buyers to source high quality vetted credit opportunities, and then aim to provide full service due diligence and execution support to ultimately guide deals to a successful close. To that end, we've now closed over $7 billion of tax credit transfers across a wide array of credit volumes and technologies. And on a slightly more fun note, in the most recent tax cycle, we were able to purchase some tax credits to use against our own tax liability. So look forward to kicking off the session here, and let's go ahead and dive in. I thought that we could perhaps start here by having a bit of a discussion just on the basics of carrybacks and carryforwards. So I will perhaps provide that context and then pass it off to our panelists to take it a step deeper. At the very highest level, tax credits can be carried back for 3 years and carried forward for 22 years. Now, there are some nuances behind that. Specifically, a tax credit purchaser does need to max out its current year liability up to the 75% statutory cap before executing a carryback. The carryback itself must be executed back to the earliest year first. So for instance, for a taxpayer working on a tax credit purchase for 2025, aiming to carry those credits back, the buyer would first carry back to 2022 up to the 75% statutory cap, then sequentially to 2023, then to 2024, of course, each year up to that 75% cap, without being able to pick and choose specific years during that carryback period. After having done that full carryback sequence, a tax credit purchaser could then carry forward the credits. So that maybe we could start off here by just discussing some key operational considerations when actually executing on a carryback claim. And maybe Brandon would love to start off with you just at a very high level, talking about things like some questions we see very often, right? What's the difference between a quick refund and a carryback claim? When would a buyer use each of these? Maybe a discussion around the Form 1139 process and how all of this ultimately translates to an impact on prior year tax returns.
Yeah, for sure. So, I think in general, it can be a little bit confusing when you're looking at a tax credit purchase and trying to make sure, obviously, you're filling up that 2025 tax credit bucket that you mentioned, Alicio. And then also, if you are planning to do a carryback, figuring out from a cash flow perspective and a timing perspective, when you pay for the credit, does it all make sense? So as you mentioned, when you purchase, for instance, a 2025 tax credit, that's going to apply first to that 2025 tax year and that 75% cap related to that tax year. So if you have already made, for whatever reason, some estimated payments related to that 25 tax year, there would be the option, if you've fully kind of used up that 75% cap in 2025, to then do a quick refund claim for those 2025 taxes that you've overpaid. To the extent there's additional excess credits that would then be carried back to 22, 23, and 24, you would first need to file your 2025 tax return first, and then do either a Form 1139 credit carryback form and or the 1120X. So you can do that quick refund claim for that 2025 tax refund before you file the 25 tax return, but you can't do the carryback claim to prior tax years until after you file that 2025 return.
Yeah, that's super helpful. Thanks, Brandon. And how should buyers, maybe as a follow-up question, how should tax credit buyers think about the actual impact to a prior year return? Let's say they're doing a carryback to, in this example, they're buying a 2025 tax credit and aiming to carry it back to, let's say, the earliest possible year, 3-year carryback, so 2022. What kind of impact does that have, practically speaking, on the 2022 return?
Yeah. So most of our clients that have done the carryback have chosen to use the Form 1139 to do the carryback, mainly because it's a little bit easier form to handle. And you can actually do all 3 years of the carryback on a single Form 1139. The only folks that, generally speaking, have chosen to use the 1120X are those that were maybe going to file an amended return anyways and had other things than just the tax credit carryback to amend on that return. But by and large, most of our clients like that idea of just filing that 1139 because it's not an amended return. The other thing to think about is when we think about that 75% per year cap, it is possible to do a carryback for only a portion of that time period and then maybe do a credit purchase in a subsequent year to then fill up those remaining buckets. For instance, you could potentially do a 25 purchase, fill up that 25% bucket, and then maybe cover a portion of 22 and 23. Then you could do a subsequent purchase in, say, 26 to then carry back to those other kind of 23, 24 years, right? Obviously, if there were tax credit purchases in those years and say 23 and 24, you'd want to factor that into that 25% cap. But there are considerations that you can play with, but there's no kind of mandatory rule that you'd have to do a carryback for the complete 3-year period.
And I guess any perspective from the group on a situation where a tax credit purchaser has already filed its return. Let's say that they filed early in April, um, but then there was still a window to purchase a 2025. This is forward looking, so April of next year they file, and then decided to, hey, I want to purchase a 2025 tax credit. The window to do so may extend until September or October, depending on what type of seller they're purchasing the credit from. Um, would that buyer have an opportunity to to purchase that credit and more importantly to execute on a carryback claim?
Yeah,
We've
so I
seen
think
that. Go ahead, Brandon. Sorry.
yeah, I was just going to say, so maybe just to provide a little bit of context, right? So in general, there's a rule under the regs that say you have to facilitate a tax credit purchase on an originally filed return with extension, right? So there's generally not a mechanism to basically complete a tax credit transfer on an amended return. So I think in theory, Alicia, what you're describing is maybe someone filing an extension, right, with their original return, filing a return, but then still filing a superseded return to potentially do a tax credit purchase. I think in theory that is possible. And I don't know, Debbie, I'll let you chime in. Have you actually had a client that's explored that option?
We've seen it on the superseding return on the sell side, right? But that's because the original return did not have the transfer, and then the superseding return did, filed in time with the extension. So not seen the reverse with the buyer, but yeah, Brandon, I'd agree with that. Yeah, in concept, maybe.
Yeah.
Go ahead, Mark.
I was gonna say, I agree. Yeah, I mean, there are pretty strict rules, particularly for the seller. There's a little bit more flexibility, I think, when the buyer can file its tax return. For the seller, uh, it's original filing with extension, but or original due date. There's no ability to amend. There's some ability to correct errors, but when a transfer is done, the buyer and seller both have to file transfer election statements with their tax return. And on that tax return, all the information needs to be on there. It can't be blank or say available upon request, but there's specific information in the regulations as to what goes in there. It's not a huge form, but just the types of credits, that it was paid in cash, and sort of generally that the requirements have been met, and it's signed under penalties of perjury. So the seller has a very strict timeline on when it needs to file that transfer election statement. The buyer's also going to have to file, with its return too. So, and there's once it's filed, it's difficult to go back and change things. There's some mechanism in there to change like numerical errors, like if there was a mistake, but it is signed under penalties of perjury and does have to have all the information in it. So more difficult.
Yeah, very, very helpful. Thank you all. Maybe switching gears a little bit to documentation, timing, and compliance considerations. And maybe a question that I'll ask Debbie, you to jump in on initially. Are you seeing any kind of requirements? I think it's a question that we see come up on occasion for special documentation of any kind within a transfer agreement, or really any deal documents specific to a carryback or a carry forward, or is the perspective here that everything that's going to happen there is kind of existing outside of the actual deal documents?
I think it's more of the latter, right? That whatever the buyer does with the credits once bought, is not, the seller isn't including language in the documentation regarding, whether it's being used for carryback or carry forward, just that it's used in compliance with, 6418 and applicable law. I do think, and y'all made some mention of this when we discussed yesterday, whether or not insurers are looking at that. Does that open the, a potential for a higher audit risk? Kind of like they started looking for the CAP program participation, and is that going to be something that they want to know ahead of time? And is it even something the buyer knows ahead of time, right? I mean, they may have allocated this for 25 and then they don't have the capacity and they look back and say, oh, shoot, I can go back to 22. So not seeing anything yet, but I can imagine where that will start to come into play, perhaps on like the insurance side.
Yeah, same with me. I haven't seen anything specific in the documents to, like tax credit transfer agreement document to, whether a buyer can carry back. I mean, and I think part of it might be, the buyer, as Debbie pointed out, I mean, it buys the credits, has to comply with things, but takes the risk on whether it's able to use the credits. So to the extent it carries them back or does something and it doesn't work, it's really, the buyer's responsibility. The one thing that I have seen discussed, and it's not really specific mention of carrybacks, is where a buyer and seller may negotiate for the timing of the payment. So when there's a tax credit transfer and the buyer has to pay in cash, but it can be negotiated when that cash payment occurs or when it can't occur earlier than certain dates or something like that. So some buyers I've seen that are interested in carrying back want to make sure they can match up as closely as possible when they're actually paying for the credits. And then after, I'm sure we'll get to this, but once they apply for a refund, there's going to be some period of delay in time before they actually get the benefit. So trying to make sure from a cash perspective that they're matching up when they pay for the credits and when they're getting the benefit of those credits. So I have seen that, but otherwise nothing specific.
Yeah, I think that's a great point, Mark. I think what we see a lot is there's obviously for our buyers just kind of two main considerations. Is one is when can we recognize the financial statement benefit, right? And then from a carryback perspective, that exact cash flow mechanism that you referenced. Obviously, we're doing a lot of 2025 tax credit transactions now, but for a lot of our large corporates that are calendar year, they're not going to be filing their 25 return until maybe October 15th of 26. So to buy a credit today that you're going to be carrying back, in 10 months, does that make sense or not? And is that cash flow hit going to eat into the ROI of the transaction? So I think that's the type of things that we see a lot of our buyers thinking about.
And I guess maybe so two follow-ups coming out of that for the group. What are some ways to structure a transaction, right, to sort of diminish the impact of having to wait? Let's say if you're buying a 2025 credit and you're in the market to do so today, however, you're not able to file your return, as you said, Brandon, until October 15th of next year. It may seem intuitive, but what are some different levers that can be pulled as a buyer to sort of diminish the pain of having to wait?
Yeah, I think one of the things that we often talk about is just kind of the quote unquote risk of waiting. So one strategy would just be to wait and try to do a transaction in May or June of 26. That's a 25 credit. Obviously, there's typically a supply and demand issue. We generally see pricing go up because there's less supply of credit. So that's obviously one strategy. Another one that we've actually done on one deal was we went ahead and executed the term sheet and tax credit transfer agreement, but we actually split up the funding in that they funded the portion that related to the current year liability immediately. And then there was a delay on the carryback portion of the credit. Obviously, you have to have a seller that's kind of willing to kind of deal with that timing delay for the funds, but the parties eventually agreed because it was nice because both parties wanted to sign the agreement up today. We got some upfront funding, and then for the portion that the buyer was going to be carrying back, there was a later funding date.
Yeah, I've seen similar, and yeah, I mean, I think negotiating around that timing is very helpful. Obviously, there's tension. I mean, sellers are going to want the cash payments to come in as soon as possible, and the buyers are wanting to push back. But if it's it's helpful if a buyer knows sort of that the carryback is a possibility as they're negotiating, so they can kind of think through those issues and make sure it's all modeled out correctly to take into account kind of the time value of money concepts.
So
Yeah, and
I think go ahead,
I'm
Debbie.
sorry, Leslie. I was just going to say, it is no different, even if there's no carryback or carry forward. Oftentimes there's the cash flow issue, right? And so, the large corporates are just trying to go ask Treasury for money at the same time they would have otherwise in order to pay their estimated taxes, right? So oftentimes that's why you see, the payment dates sort of coinciding with their estimated tax payment dates, and then to hit the accounting benefits, I guess, that come with maybe paying for a 25 credit in 2026. If you're going to carry back, like Brandon said, you've got to wait until after October and you file, and then you can, go back to 23 or whatever. So I am seeing a lot of negotiation around being able to make those later payments. And I just think everybody has to figure out with the seller, if they've got like a bridge loan or something that is tied to receiving these proceeds, or their tax equity partner has to be on board with not getting these until later in time, well after the project has hit its substantial completion, then that's just all part of the game, right? And the negotiation on price and everything.
Yeah, it's a great point, Debbie. And I mean, for our part, maybe what I can quickly say is that sometimes it really is just as simple as a math equation on sort of each company's respective cost of capital. And one interesting theme there, of course, is that many tax credit purchasers are very, very large, not always, but sometimes are, either large or established businesses that have been around for a very long time and maybe have a pretty attractive cost of capital. And if you compare that to the sell side, that may not always be the case. And so, there's always that lever to pull on the headline purchase price that's being paid relative to the payment timing. And so those are scenarios that I think, sometimes make sense where maybe a tax credit buyer is paying a little bit more than the market up front, but they're getting the benefit of a delayed payment because they have a pretty attractive cost of capital.
Absolutely.
One kind of hot button item that we touched on as part of this conversation was the actual refund timing itself. Once a tax credit buyer has actually filed its return and has been able to submit, the form 1139 or whatever form is electing to get used, I guess what is the group sort of seeing in the market for refund timing? Whether anecdotally or otherwise, and are there nuance factors behind that, such as JCT reviews, et cetera, once you get to certain size thresholds?
Yeah, I can start there. So, practically speaking, the quickest carryback refund we've seen issued was about 4 weeks, which was very fast, and we were very pleasantly surprised. I would say more commonly it's been around that kind of 6-month threshold. On the ones that take longer, you will get paid interest on those. The way the rules generally are supposed to work is the IRS has 45 days from the date of filing the 1139 to issue the refund, and if they don't, it accrues interest. Quite frankly, we've seen kind of the interest payment date that they're using kind of fluctuate from deal to deal, and it doesn't always make a ton of sense. And then obviously, we actually have a fair number of carryback claims that are still pending with the IRS. There's obviously a lot going on right now with the IRS, which can obviously impact refund timing. So I think it is an important consideration to discuss, in that obviously from a deal transaction standpoint, there's going to be a lot of stuff within our control. When we can actually file that current year return is within our control. When we can file that carryback claim is in our control. And then waiting on the IRS is just kind of the one piece. So it's important to know that if there is a delay, you should get paid interest on a good chunk of that. But the actual timing's, unfortunately, I think, going to be variable.
Yeah. And Brandon, what's the what the interest rate is? It's like a federal short-term rate plus
2%, I believe,
yeah.
for
maybe
corporates. Two
Okay.
to three. I think it's a plus 2% or plus 3%, depending on the filing entity. But the rates the IRS does publish the rates
Right.
quarterly. And so right now it is, I believe, either a 6% or 7% interest rate, depending on what type of entity that is filing.
Yeah. Yeah, I just only asked it because I think it's helpful to keep in mind that there is this 45-day period where you start getting interest. Not as helpful with Brandon saying where maybe that the date that starts isn't always as clear, but just kind of, planning around where there's delays. There is this interest payment and keeping kind of in mind like what that rate is can be helpful.
Do you guys think there is any basis for this delay being, obviously there's going to be delays in IRS and government shutdowns, et cetera, right? But any reason to think this particular type of carryback, request is delaying things more than maybe normal if there was some other situation for amending your return? Any anecdotal, anybody's hearing anything like that? I know I have clients waiting to get, so I'm just curious.
Yeah, I don't know. I have, I mean, I think that some people may be worried, but I haven't I don't know the answer to that, like if there is, but yeah, it's an interesting question whether there's maybe something more. But I do think that there's also, situations where, we have seen refunds paid, so that's helpful. And as Brandon said, he's seen some that are relatively quick, but
Perhaps a quick anecdote, Debbie, because it's a great question. We do have a client that that recently, filed an 1139 as part of its 2024 return very recently. And within about 8 weeks, 6 to 8 weeks, did receive notice from the IRS that the refund, had been approved and processed. So again, that was less than 2 months in the most recent cycle. Now I think one interesting nuance there is that this particular client does have a bit more of a simple return profile, right? They're not dealing with transfer pricing and foreign involvement and things of that nature. So I suppose that is one anecdotal consideration, is when you look at it holistically, how complex is your return, and that will likely lend itself to processing timelines.
Makes sense.
And maybe the last thing I would add is that it is also our understanding that that smaller carryback claims, specifically claims under $5 million, are not subject to JCT review, which of course should also lend itself to a more expedited refund processing timeline.
Yep. And I think that's a great point in that, potentially there could be some planning when you think about sizing the credit. So if that is something that you are concerned about, you could potentially, as you're sizing that current year purchase and knowing how much you want to carry back, that's a consideration that some buyers have thought through in terms of staying under that $5 million threshold.
And yeah, so maybe related to all of this, I think one question that comes up is just thinking about audit risk related to a carryback. I guess any insights from the group on any kind of perceived or actual increase in audit risk, and what is the perspective on how that may or may not change if a company is part of the CAP program?
Yeah, so I am aware of one particular client that is current, that the year that they carried back and they carried back as part of an 1120X is under audit. So there was an IDR issued related to the tax credit purchases. However, there was also IDRs related to non-tax credit issues as well. So it's currently ongoing, and those IDRs have been responded to. So we'll see how it all plays out in terms of, hey, did the carryback have any sort of material sway in terms of whether it was actually pulled for audit? We haven't gotten that sort of insight from the IRS, but there were multiple IDRs, not just a tax credit purchase related IDR.
I can't say that I've seen that. Obviously, transactionally, I think I mentioned before, our insurer is going to think that it causes a higher risk of audit and therefore start, pricing or like they do for CAP, making a rep. You're not in the CAP program, right? Covenant not to be in it for the next 5 years or whatever. So I don't know if that'll come about or not. And I'm not giving them any ideas if they're on this webinar.
Yeah. And I'm aware of clients that are in the CAP program that have purchased credits. So, obviously it's a little bit different profile. I'm not aware of anything that concerned that client about being in the CAP program. I think just like most of the issues, I think their general approach is to have the conversation with the CAP team up front, right? And I think when you do that, then when the transaction actually does occur, there's no surprises. So at least for that one particular client, I've not heard of any friction that they've had with the CAP team related to tax credit purchases. But Debbie's spot on. Obviously, when it comes to tax insurers and then as part of the deal, it's a pretty standard question whether or not the buyer is part of the CAP program.
Well, I'd love to, we're fortunate to have a panel here that's been able to see some of these play out in real time on real transactions. So would love to maybe hop over to some practical insights. And maybe just starting off with, for our tax credit purchasers in the audience here, what type of profile makes most sense? Who is a good candidate for a tax credit carryback? Would love to maybe start there.
Yeah, maybe I can chime in. So I think, I know like we have some buyers who are very active and do a lot of tax credit purchases. And so, they're ones that are actively looking into, does it make sense to just keep, buying some of these credits where they're getting really good pricing and carry back. And then we have other buyers who maybe aren't doing as much, but just have um, a significant tax liability from a prior year because maybe they had you know, some extraordinary event, like a huge sale of some particular line of business or something like that, where they're looking to, maybe not, they don't have a lot of tax liability this year. Don't think they'll be able to use it, but want to explore whether it makes sense to buy a tax credit and carry back. So we've seen that. And then I think, I know we've kind of gone through it before, but I think, practically like thinking through it, I think Alicia, you said like a math exercise, I think is a good way to kind of think about it. Like a buyer should consider sort of, okay, like what's my discount I'm getting in the credit and when do I have to actually pay cash for it? When am I going to be able to file a claim for refund? What does it look like with the delay, factoring in the interest payments that we talked about after 45 days? And then, building in when you're modeling it out, what would it look like if there was a delay in refund, right? I mean, if you did have to wait for a certain amount of time, when does this start to look, not as good? So I think kind of going through all that exercise and modeling is really important.
And I think, Brandon, you brought up an interesting point where maybe on the other side of this, let's say, so I think, for instance, Mark, I love your point about, a large one-time event in the past, whether that's a sale of the business or something else. Brandon, you mentioned something interesting about, perhaps relatively smaller tax credit purchasers that can actually leverage this to get sort of scale in their transaction and get to something that makes more sense from an overall economics perspective.
Yeah, that's exactly right. So, there might be some clients out there that maybe historically a tax equity investment didn't make sense just because their overall annual tax liability was not large enough. What we have found is with some of those quote unquote smaller taxpayers, obviously when you aggregate that 4-year tax liability window instead of just looking at a 1 year by itself, then all of a sudden the juice is worth the squeeze for doing a transaction, right? Because instead of maybe a $2 million purchase, it's an $8 million purchase, right? So obviously each company needs to kind of determine what kind of tax savings is meaningful to them, but it's made a lot of sense for a lot of these smaller corporates to just go ahead and do that carryback because you're able to aggregate in that 4-year window. So what it's done is it's brought new entrants to the market that maybe wouldn't have just done a purchase if all they could do is offset that current year liability.
Yeah, that's super helpful. Thank you both. Would love to maybe just kind of bring this to life a little bit with a real transaction, at least anecdotally. I guess would one of you be able to just kind of speak to a recent deal that you went through, maybe share a little bit about what types of credits these were, sort of what the key terms looked like, and how, the tax credit purchaser was able to execute on a strategy here to sort of optimize their tax profile.
Yeah, I can share kind of a real life story, mainly because it's the one that got the refund within 4 weeks, so it all went perfectly according to plan. But what they actually did was we actually started moving on a credit. It was that 2024 tax credit transaction for an ITC. We actually kind of kicked off the process in kind of February, March timeframe of 25. So signed a term sheet in say late March, early April, did kind of the 30-day standard, diligence period. In the background, the kind of CLA tax compliance team had kind of gotten the return ready to go. So basically we were just waiting for the tax credit transaction to close. Tax credit transaction closed, I think at the end of June. The team filed the return in early July, literally filed the 1139 the day after the filing of the tax return. And then 4 weeks later, they actually got the refund in the mail. What's interesting is they actually did get a letter, what we basically call as a quote unquote desk audit, where the IRS basically said, hey, we issued your refund, but we saw that, you asked it for this pretty significant refund. Tell us more about it. So we did furnish information related to the tax credit purchase. They reviewed the information and said, okay, sounds good. But what's interesting about the whole process is they actually did issue their refund prior to that kind of desk audit. So it was interesting that the cash was actually received prior to that. Again, I'm sure there's probably other stories out there not quite as favorable, but that one kind of worked out exactly how we drew it up.
Yeah, that's awesome.
I think, like we said at the top of the hour, I think in some cases the buyer, is just acquiring the credits and maybe has a plan for them to carry back or forward, maybe not, right? And so transactionally, I don't know that the documents look that much different, but the timing of the payment, like we were talking about, I do find it interesting that, especially if a buyer has a non-calendar tax year, right? And so we've seen buyers, and just on the straight up buy or on a carryback carry forward basis, sort of be able to take advantage of that. With most of your sponsors out there have a calendar tax year, so in their partnerships and they're filing in September, right? And so there is some leverage there for some buyers that have a later or a fiscal year, and that's different than the calendar year, and the timing of their payments working with the seller. I don't know, I think that is one area where they do the math, so to speak, and they are able to, they have a different variable because their tax year is different. So and that might help them on the carry back situation too. So that's, and I will say, we were transacting on 24 credits right up into October. I think Brandon, we were 2-1. So they're available, and maybe the pricing is higher at first, but then goes down because people start to get a little desperate, and maybe there's more hair on some of them or something. But I think if people are finding that their projected tax capacity is different or changes, like Mark said, because of an acquisition or some sort of situation with the entity that changes, being able to find credits towards the end of the tax filing period for that prior year, and then looking and be able to carry them back, that's there. And so I think in the pricing and the timing of payment, it's obviously all negotiable, but there are definitely willing sellers out there, and buyers are getting more creative in how they address this with the payment timing.
Yeah, it's a great point, Debbie. I know certainly on our end, the market was tremendously active right up until the wire. 9:15 for partnerships, 10:15 for corporates. We had a number of deals close, the day before or the day of, right up against the wire. And yeah, to your point, there definitely are opportunities, and really depending on how close you are up into the wire. If it's the day before, pricing may end up being pretty attractive to a buyer that's able to mobilize forces in 24 to 48 hours. But if you're 3, 4, 5, 6 weeks before the filing deadlines, I think certainly what we saw, I think consistent with your comment, is that the pricing can be a bit competitive, as there's a number of buyers that are perhaps coming up for air, looking to fill out their liability for the year, and there are relatively few opportunities from tax credit sellers. So pricing can get a bit competitive there. In the context of carrybacks, are there any specific, whether it's related to mechanical considerations or even just deal terms, as these come together, is there a view on specific types of credits that are maybe better suited for a carryback strategy than others? If a buyer, in other words, if a buyer is going to come to the market and has in mind that they want to execute on a carryback strategy, are there certain credits that they should kind of be on the hunt for relative to others?
Yeah, so I think the key there, and I know we were chatting about a little bit right before the webinar started, is, and I know in particular this is relevant for a lot of our financial institution clients that may have other types of general business credits. So when we think about the general business credit landscape, right, that could include low-income housing tax credits, that could include research and development tax credits, that could include WOTC tax credits. So there are many taxpayers out there that have other general business credits other than just the tax credits they're purchasing. Those other credits may have different carrybacks and carryforward periods. And there's actually an ordering rule in the Form 3800 instructions that tell you which credits you have to apply to the current year tax first, which can then impact which credit is actually carried back. So at a super high level, if you have other general business credits in your kind of credit box, it is important to know those ordering rules and then know which credits will be utilized first and then which credit would ultimately be carried back to a prior tax year.
I think just anecdotally, and got a shout out to my own tax partners because that's not what I am. But I do know that there have been clients who've requested to be able to use certain credits on a carryback basis against certain types of income, and so without getting over my skis here too much, I would say that there should be caution about what's the type of income that's trying to be for which the credits are trying to be used, and whether there may be a limitation on a 48 versus a 48E, for example. So I can't give you specifics on that. I know enough to tell you that it should be cautious and as to what the income is and whether the particular type of credit. But otherwise, I don't think that there's a it's better to have a PTC or an ITC or a 45X or Z or whatever. So.
Yeah, super helpful. Yeah. Go ahead, Mark.
I was gonna say, I think that's right. Yeah, other than the ordering rules that we talked about, I think also, credits that maybe have larger discounts, maybe that's easier to make things work. But I mean, that's not the only consideration, but not really a specific credit type, but that could be helpful as well, just because there's more, there's more discount already built in. So if you have to factor that in to make sure it works.
Perhaps to kind of bring some of the discussion together on this, any practical advice to a tax credit purchaser that's kind of navigating all these provisions for the first time? What are the the kind of the key takeaways? What are the most important things to sort of focus on as they put a strategy together?
Number one, hire qualified tax professionals to help, right? For sure. No, I'm just kidding. No, I think honestly, on the carryback strategy, the timing consideration really is the kind of key thing to work through. From a current year perspective, the way that most of my clients think about it is that your IRR or ROI is pretty much infinite if you're directly offsetting an estimated tax payment with a tax credit purchase. That really is a slam dunk. The carryback strategy, just given the uncertainty with the IRS, there is more of those timing considerations. So I think it is more of a quote unquote investment. And so that really is the kind of key thing to be looking at. You know, are there special kind of tips and tricks to try to make the refund go faster? I wish there were, but I don't think we're aware of any. So I think it's just, you know, knowing the strategy, mapping out those scenarios that Mark mentioned of, hey, here's what it would be if we got the refund in 3 months, first 6 months, first 9 months, first 12 months. So that way you just let all the relevant stakeholders know these are the possibilities. Net, there's going to be quite a bit of tax savings out there, right? Which is why so many folks are doing it, because they're saving millions of dollars. You know, it just might be those timing considerations need to be worked through.
Yeah, that's super helpful. Thanks, Brandon. You know, would love to perhaps transition over to a bit of a quick market update here, and then we can close out with some audience Q&A. It looks like we have some great questions from the audience here. So maybe just first question, kind of getting a lay of the land in terms of what the current landscape looks like for tax credit supply and perhaps even pricing trends, you know, coming out of the One Big Beautiful Bill Act. Would love to hear from our panel here sort of what you're seeing play out in real time as the story, maybe, you know, for this calendar year, and sort of any opinions or projections as we go into 2026.
The market's hot. I'll be honest, we're very busy on these transactions. I think the uncertainty around the OB3, or at least in the initial days, you know, put a pause on some people's thoughts about this. But once they, you know, finally got the writing done and signed off, I think it went right back to where it was. I'm seeing a lot of trends in all different types of credits, right? Not, you know, the old 45s and 48s, of course, but there are, you know, other credits are for sure transacting, clean fuel, etc. Nuclear will be big. I've seen more than usual of people taking, you know, futures, if you will, like taking 10-year strings or something. I'm seeing more PTCs on solar than ITCs because it just, you know, it's working for the sponsors' financials better. So people are getting a little bit creative, I would say. I do think that there's still caution. You know, we talked about insurance before. The insurance market is getting more conservative, I guess I would say, than they were in the initial days. So, you know, that's a pricing consideration, and then you know, what holes are there in the exclusions consideration for the buyers. But you know, even Resi has taken its hits, but kind of got new life with OB3. So I see things going swimmingly for buyers in 2026, as long as the IRS gives us refunds quickly.
Yeah, I think that's the punchline. I think what we're seeing right now is that it really is trending to a buyer's market. There's just quite a bit of tax credit supply out there. I think that is in part due to Section 45Z being effective for 1/1/25 tax years moving forward. So we've got this new credit coming to market. So there's some additional supply. OB3 reduced the tax liability for some taxpayers in some segments. So maybe we had buyers that maybe their liability either went away completely or decreased. And then we have maybe an additional supply of credits, at least in the short term. So I think what that's created is just some very nice opportunities for the buyers that are still in the market. And I think we've seen that based off all those things that we just talked about in terms of pricing, timing of payment, things of that nature. So you know, from a buyer's perspective, there's never been a better time to kind of jump in.
I don't know that I had much to add. I mean, I'm seeing the same thing, you know, more buyer friendly. I think, you know, there's, you know, many more tax credits that I'm seeing. And then, you know, a lot of projects it takes a long time to sort of develop certain types of projects. And so there's, any effects on tax credit supply take a long time. So there still seems like there's a good amount of supply, but maybe not as many buyers. So that, adds up to making it better for buyers in general. But
Yeah, and certainly, would completely agree with everything that the panel has just shared, and I think it does present this really unique opportunity, for buyers that do have appetite for 2025, that are willing to move forward on a purchase, whether that's a regular way purchase or part of a carryback strategy. It does kind of present this very unique opportunity to get credits at an attractive price, or even negotiate, a delayed payment timing. I think Brandon brought up a great example of, having multiple payment dates, or maybe even a single payment date that's some point in the future. And so I think the big takeaway there is that there's no reason to assume as a tax credit purchaser that you need to make a payment for the credits as soon as the transaction closes. I think perhaps the perspective is that you can begin working on a tax credit purchase today, and even sign a term sheet, sign a TCPA, and perhaps negotiate some kind of delayed or deferred payment structure, whether in milestones or lump sums, et cetera. There was an interesting comment that was brought up by, I think, Debbie and Brandon on the 45Z clean fuel credit. It does feel like that is a credit that has been offering a lot of supply to the market, and has also been piquing a lot of interest on the buy side. Would love to get some commentary from each of you on what that buzz is all about. Why is it an attractive credit? And maybe just even a quick update on sort of where the guidance is related to that credit.
I can take that. So yeah, the 45Z credit is a production-based credit. So we have, in general, like we have certain credits that are more, investment-based, and this one's a production-based one. It's generally based on producing and selling clean transportation fuels that have a reduced life cycle greenhouse gas emissions rate. It came out a little while ago, but it's one that the OB3 didn't affect as much. I mean, in general, the trend was like IRA credits that a lot of them were scaled back, or have sunset dates now, or things like that. So this one was one that was actually extended for 2 years. So there's a thinking like this is going to be around a little bit longer. It's maybe looked at maybe more favorably by a lot of people for that reason. And I guess on the guidance point, I think that's one thing though to consider, is that we don't really have regulations yet. We do have notices, and one of the notices has a draft of proposed regulations, which is a bit unusual, like to have a notice that actually ahead of time shows what the text of proposed regulations look like. So we do expect that we will actually get proposed regulations, and then eventually final regulations, which will be helpful. There's a lot of interest in this, and so we're seeing a lot of 45Z deals coming in. There are some points that we expect some clarification on, particularly around like you have to produce and sell to unrelated parties, and certain sales count that are qualifying sales, and maybe there's some ambiguity there where future guidance could help to make sure that common sales, common market transactions are okay.
Yeah. And I think, Mark, just to piggyback off that, I think why 45Zs have now become pretty attractive, especially over the last 90 days, is what we have seen is because maybe they're quote unquote new. Obviously, generally speaking, PTCs are deemed kind of less risky in the market because there's no recapture risk. But we're seeing the pricing for 45Zs in general be a little bit closer to ITC pricing than PTC pricing. So the buyers that are moving now, they're basically getting ITC similar pricing, but on a PTC credit. So again, back to the theme about this really is a buyer's market. I think that's kind of a nice potential way, and why buyers have decided to start moving on the 45Zs.
And maybe kind of another credit theme, Debbie, I think you had mentioned, nuclear credits. Would love to hear, just from anyone here, kind of what some of the emerging themes are there, especially as it relates to potentially some new supply under 45Y for nuclear. Any kind of emerging themes or perhaps predictions as it relates to, the zero emission nuclear credits or otherwise?
I don't know if I have any predictions other than, like you mentioned. I mean, it could be a lot more of them soon, right? um, uh, and I think, I mean, we're transacting on them, right? And
Yeah.
depending on, they are great for buyers who have a huge load of capacity, right? There's a lot of credits there. So that's where, we're seeing with the activity more with a larger buyer. I would imagine that the concepts that are, the topic of this webinar, to be able to carry back, that's again another source of a large chunk of credits, um, uh, and they're pretty solid. I mean, they're PTCs, so they're good to diligence, and they have a bit more comfort, and they're often being generated by entities that have sufficient creditworthiness and wherewithal to stand behind the obligations and indemnities that go into those TCTAs. So I'm open for Brandon or Mark to chime in on any of the regulatory side of things too.
I agree. I guess I would just also add, I mean, there's certain, I think we already talked about this with 45Z. There's certain credits that maybe came out, better than others, and, one big beautiful bill, and, the nuclear credits I would put also on the side where, they weren't as affected. So, than some of the other credits. And so they can be more favorable that way.
And maybe the last thing that I would perhaps add is, sort of the credit calculation. This is perhaps one theme that we've seen is certainly on the 45U nuclear side of things, is just given how closely the credit calculation is tied to power pricing. We have seen, especially when we think about the evolution of data centers and general power pricing themes in the market today on a macro level. I think the general expectation is that power prices will, continue to go up and to the right. And as a result, we are seeing some examples of that nuclear supply decrease as a result. So someone that was doing, 100 or 200 million of 45U credits in 2024 is maybe doing a third of that in 2025. So it does feel like there is some scarcity, at least on the 45U front, to the extent power prices can continue to climb up. Would love to kind of maybe wrap us up with some Q&A here. We're able to cover a lot of questions that I'm seeing in the Q&A box during the live session. But maybe a specific one here that I'll just read out. So if a 2025 credit is purchased for, but the 25 return is not yet filed, but no tax is expected to be due for the 2025 tax year, can an amended return be filed via 1120X for 22, 23, and 24 tax years using the 25 tax credit purchase? Brandon, you look like you're ready to jump in.
Yeah, love that one. No, look, I'm not an IRS practice and procedure person, but yeah, I mean, yeah, the fact that there's no liability in 25 obviously does not preclude you to purchase the credit. You still need obviously to report that credit on 25 return, and then you'll carry it back. I think the question is probably getting at if, like, from a timing consideration, is there any way to kind of speed up that timing of the carryback? I would just be, depending on how large the carryback is, I would just be very careful about getting cute with, trying to kind of mess with that timing. The strategy still works even if there's no liability in 25, but you just want to be careful that you're following kind of the normal practice and procedure in terms of the ordering rules. the question makes sense in that, hey, I know how much I need to carry back, right? So do I really need to wait? It's a great question. I've not had a client do that yet that had a zero liability and kind of tried to preempt the filing, but it's an interesting strategy to think about.
I guess I would chime in. You guys tell me if the buyer is eager to carry that back and files their return, say in April, like I don't know any buyer that does it, but whatever, say they file in April, the seller has not yet filed their return, right? Can they go ahead? Is the transfer complete? I don't know that. I don't know the answer to that. I'm sort of asking Brandon or Mark if you're, on the tax side.
Yeah.
Because to me, they both have to be filed is my kind of thought process.
Yeah, I mean, I think, in that situation, the seller would be obligated to file. I mean, the timing's different, but each party files with their respective tax returns and they've already agreed that they're filing as, they've both executed a transfer election statement that says that they're transferring. Buyer has filed. So from the buyer's perspective, they've reported that tax credit at that time. So I would say.
So they could go ahead and file for the 24 carryback, for example, if that's what they were going for.
Yeah, Mark, I agree.
Well, I know we're up at time here, so wanted to just give a quick thank you to our panelists, Brandon, Mark, and Debbie. Thank you so much for joining, and thank you to the audience as well. Really appreciate the time, and we'll look forward to sharing the recording within the next few days.
Sounds
Thank
good.
you.
Thanks
all.
for having us. Take care.